All right, good morning. It is Monday, the 23rd of June. Let's see what we get in the markets. Okay, so we have FOMC on GBPUSD on market open, but it's not high impact, it's medium impact. Then we have PMI, PMI, and PMI. At 10:30, so about an hour and a half after London open, and then close to New York open, we have PMI on USD. So we have some news, but it's not really that high impact that I might stay out for the day. So I'll still be looking for a setup, because the thing is, the only news events that I really avoid might be CPI, FOMC, unemployment claims, and unemployment rate, and those are the big ones that I really try to avoid. Also PPI, I also avoid PPI because it's a lot of manipulation in those markets, so it's just better to stay out and avoid getting manipulated in your trades, or just trading low probability markets. That's all I'm trying to say. Okay, so these are my highs and lows on the 4-hour. As of right now, we are bearish. We did break market structure right here with these new highs forming, but then we pushed down again and we gapped down on market open, and we closed below these lows. So as of right now, we are bearish. This might just be manipulation, so we'll see about that. But the thing is, if that's manipulation and we are distributing right now, pushing up towards the highest, because you can see with the gap being right here. Let me just mark it up with the red lines. With this being the gap, we are in it right now. So what could happen is we could fill the gap and continue pushing up, and then we most probably won't find a trade today, because I'll be looking to trade either longs or shorts depending on which side the market closes on. And as of right now, on the hourly time frame, we are in the highs, which are basically inside of the gap. So we are in the hourly highs right now. These are my hourly lows, and what I'm going to be looking for is either a close above these highs or a close below these lows. But the thing is, if we do get a close above these highs, I mean, it's just like the last live video I did. It will be a low probability trade because of my 4-hour time frame that is not yet bullish. So I guess I can take it, because I do not mind taking low probability trades as long as the trade is following. Actually, 1 hour is bearish right now. As long as the trade follows my trading plan, I will take it, whether it's high probability or low probability. So if the hourly closes above these highs, then we are bullish, where we will no longer be bearish. Let's look at the 15-minute. Right, so the 15-minute rallied pretty hard. We might see something, if we do push up, we might see something like this, a slight retracement right now, which will be followed by the break. We could also just push through right now, but usually that doesn't happen first try. As you can see, I tried to push, and it's still going to retrace again and then push up. So we'll see what happens there. But the thing you have to understand with low probability trades is, essentially, if you do have long-term positive expected value, whether it's a low probability trade or a high probability trade, it doesn't really matter, because as long as your expected value in the long term is positive, then you can still take low probability trades. Because I have backtested trades like this multiple times, hundreds of times before, where all of my time frames align except for the 4-hour. Now I've found that I've usually gotten around a 32% win rate with this setup and around a 2.6 risk to reward. So I mean, that tells you everything you need to know. My expected value is positive because I don't even need a 30% win rate to be profitable. I mean, I can be profitable with a 28% win rate with a 2.6 risk to reward. So that's good enough for me. As long as my long-term expected value is positive, you can still take low probability trades. But if those low probability trades mean that your expected value drops long term, or not necessarily drops, but rather gets close to not being positive or isn't positive with a certain setup, then you should never take that setup. Because whether it's a low probability or a high probability trade, it doesn't really matter, because what will happen in the long term is what you should be focusing on. So whether that setup is profitable long term or not, that should be the deciding factor on whether you can or cannot take this trade. So whether I can or cannot take this long position is determined on my expected value over a few hundred trades, and my expected value over these few hundred trades is positive with this specific setup. So naturally that will give me an indication that I can safely take this trade without a problem. So usually what I like to do is I'll put my stop loss 2 pips below the second to last recent low. So as you can see, this is a low, and then this is the recent low. So this is the second to last recent low, and I'll put my stop loss 2 pips below it, and I'll put my take profit at a 1-to-1, like a 39, around there. So this is usually what I'm looking for, and then I'll add to my trade, you know, as we retrace. For example, we do something like this, then over here I might have added a position, and over here I might have added a position. So that's 3 total positions, which gives me a higher risk to reward, obviously, than a 1-to-1. And the reason I do that is because I've found that with, let's say for example, I want to target a 2.6 risk to reward on a certain trade, and I do that for all of my trades, my win rate might get to as low as 30%, maybe even lower. Yes, I could still be profitable, but I'll have an extremely low win rate. And trading low win rates it's difficult because you have psychological issues that you struggle with, especially revenge trading and FOMO, because you'll always want to take another position in hopes of making some profit, because you know you don't see profit a lot in the short term with a low win rate setup, and that's the problem. That's why I'd rather take a higher probability risk to reward on my first position, which is a 1-to-1. So that already makes my probability of winning higher, and as the trade runs, naturally as I add positions, I also trail my stop loss, and by trailing my stop loss, that also starts to take down my probability of winning. So my chances at winning becomes lower as I add positions. So that's the thing. Even though my chances at winning becomes lower, it's still higher than say, for example, just taking a normal 2.6 risk to reward, because I might only get a 2.1 or a 2 risk to reward out of this trade and win it. And in the long term, you know, sometimes I might catch, for example, 3 risk to rewards or 4 risk to rewards, and those trades push up my average risk to reward. Now those trades, I usually don't win them, because the higher your risk to reward, the lower your probability of winning, but my expected value goes up, and that's what you need to understand. That's what I'm trying to explain. It's not about having a good trade in front of you, it's about having 100 of them. You know, seeing this trade play out 100 times using different risk to rewards. But for example, using the same risk to reward on your entry, you know, adding positions, things like that. How does this perform in the long term? Is it positive or is it negative? And that's what you need to look at. That's about my lesson that I want to give you. Just probabilities, looking in the long term. But as of right now, we have a 5-minute candle pushing up. It pushed up quite quickly. I think it's because of the FOMC. So this might just be manipulation, or it is the breakout. So if this 5-minute candle closes, I'll be taking a long position, 1-to-1 risk reward, 2 pips below this, and I'll add to my position as we push and retrace. Thank you.